Hey there, everybody. Brian Hoops here with Midwest Market Solutions. Thank you for joining us here this evening as we talk about markets and marketing. We are recording this session, so it will be up on our website. So if you're unable to attend or if you get knocked out, you can view it at a later date. So hopefully you find this information of a benefit to you. Since our last meeting back in August, we have added one more brokerage office. This will be in Pocahontas, Iowa, and they are starting October the 1st with us. So at the end of the month, we'll be expanding one more office there. And of course, if you're in that area of Pocahontas, please stop in and say hi, introduce yourself there to them. All right, as we look at the meeting here, we're going to talk about a few different things. We're going to go through the supply and demand numbers. We're going to talk about carry out and some marketing strategies. So I hope this is a benefit to you and that you'll be able to get some information out of it. And of course, if you have any questions, contact me. Let me know what's going on. As far as production today, I didn't feel that this was a real surprise. It did come in production-wise, corn and beans above the average trade guess. As I said, I did not think this was much of a surprise to the trade. I thought we would see very minimal changes from the USDA, and that's pretty much what we saw here as production numbers slightly higher, about almost half a bushel for corn, and for soybeans bigger than last month. So I don't think that's a real shock, but it did put a little pressure against the trade. Now, question is, will this be the largest production figure of the year? As we get into October, we'll actually have some harvest data that the USDA can use. Now, it's not been a great finish to the growing season. It's been fairly dry across most of the Midwest as we got into the last half of August and all of September so far. It's been many weeks without a rain, and that is going to limit, I think, the chances that we'll see any type of increase in the production here. Getting a question. All right. Some people tell me they are having technical troubles getting in. All right, so hopefully that will fix some of the issues and everybody can keep going here. All right, as we look at the let's see what we're doing here. Trying to help somebody out online here. Just a second, see if we can get. They're having some technical issues, and maybe we can get them straightened out on what to do here. So hopefully that's the case anyway. All right, we'll continue going through here, and hopefully everybody get their technical issues worked out, and we can go forward. Yield-wise, production-wise, we are looking at a little bit bigger numbers here from what the USDA had said. But again, this could be the biggest one that we see for the year, and I don't expect that we'll see much in the way of increases in production going forward for corn and for soybeans. Okay. And as far as our ending stocks, they came in a little bit above average guess in corn. Quite a bit above, almost 200 million bushels larger. Soybeans, pretty large as well, about 45 or 50 million bushels more than last month. And wheat also a little bit larger than the average trade guess. And compared to last year, only the wheat market has cut into those ending stocks. Last year, soybean ending stocks about 410 million, and corn at 2.370. So very minimal changes in corn. Soybeans were increase, and wheat was actually down from last year. All right, let's get into some of the numbers here as far as what the USDA said here. There was not many major changes. They increased the yield in the corn by almost half a bushel. This is the third largest crop in history based off of the yield, and history has told us from now to the final, in 11 out of the last 16 years, corn yields have advanced. So not 100% number, but odds are in the favor of increase in yield history. The old adage is big crops tend to get bigger. Stocks increased by 62 million as usage slows by 50 million bushels, and our production is going to be outpaced by our usage. 14.18 billion bushels. Our usage is 14.25. So we're using more crop than what we're producing, and that's one of the few positives we can say in here. Now, last time we did this report, we talked about a weather cycle. It changed August 14th to a hot and dry period, and you notice we have gotten very dry for this time of year. Things have really dried out, so that cycle was pretty much on cue as far as weather patterns. By September 26th, we're going to change to more of a cool and wetter pattern, and when we say cool in the fall, it's going to be cool anyway, but definitely look out for some wetter conditions during harvest, and we could see quite a few harvest delays if this number is accurate. So the weather people we use also verify that they're looking for some pretty heavy rain chances by mid-October timeframe that should slow the harvest activity. Looking at the soybeans, production increased by half a bushel per acre there. This is the second largest crop in history based off of the yield forecast. So right now we've got a yield of 49.9 bushels per acre. Last year was 52.1. I don't think we're going to eclipse that. The yield advanced in 6 out of the last 8 years from now until the final time frame. That yield has had a tendency to advance. That's about 70% of the time, but certainly not 100% of the time. Usage did improve by 25 million bushels. It's a new record, and we are seeing better usage, 143 million bushels more than a year ago. We'll see the largest production, however, this year because of larger planted acreage. We still have that insurance guarantee at 1017. That hasn't changed. Dry weather could fuel ideas of some yield losses. So that's what we were talking about at the beginning of the meeting. We're likely to see some yield losses starting to trickle in October because of this dry weather pattern that we're going to have, and that's not going to change until about the 25th, 26th of the month of September. Okay, so not much changes in wheat. In fact, if you look at the balance sheet, there's 0 changes there. No winter wheat supply issues. We talked about that last report, and in fact, hard red spring supplies increasing due to the Canadian production. They are about 1/3 done with their harvest there, and it's likely we'll see some sort of a rally after we get around September 20th. That's when they'll be half to 2/3 done. That's when seasonally Minneapolis wheat tends to bottom and starts to rally. That's our secondary rally. And we have tighter supplies here, but with Canada producing larger crop than what was expected, that means we don't have to have quite as much demand for the United States wheat. Our spring wheat crop, we're going to talk about storage here a little bit more in a second, but this suggests we store the crop until March and sell the carry, and we should have another rally phase or rationing phase starting in September, and that's where we want to try and go ahead and sell into. Okay, so let's look at the strategies here that we want to employ with our clients here. Funds currently are net short, and this is corn, soybeans, and wheat, and they normally build longs into the fourth quarter. So I don't think we can really take on a real bearish stance at this point because the funds are likely to start coming out of these short positions. We're at the midway point in September, and now that the crop report's out of the way and yields could be shrinking because of dryness concerns, I don't think there's a reason to press the short side. Now, because we're at these lows, if you want to manage your risk, use options to do that. This is the best way to go. I've priced some December puts there, November soybean puts. This would allow you to have upside potential. You could take a look here at the markets. 350 December corn puts are about a dime. 950 November bean puts are 20 cents. And that'll get you through the next couple months. And you can see harvest, if we have bigger harvest data and the funds don't cover their shorts and price is lower, we could see markets rally, and you don't want to be caught selling or hedging at this price level when there is a good chance. I think we're going to see some upside potential here going into the October timeframe. Now, once we get a rally, I really like selling out of the money calls to pay for that storage. As I said, I don't think today is the day to sell those out of money calls, but I did price them off of today's closing prices. May corn calls, $4 calls are about a dime right now, and May bean 1060 calls are at 19 cents. So as we were trading tonight, May soybeans are trading at 9.86 So they're 80 cents out of the money. And when you sell these options, how that works is you get to take in the premium, 19-cent premium. That's yours to keep. If prices move higher and rally up to that 1060 area, you can go ahead and sell your product, your crop at that higher price level. You have to buy your calls back at that same time if you're liquidating your cash. But this is called a coverage call. I think it's a great opportunity, especially if you're going to store your crop. Get paid for that storage with these premiums, and if prices move higher, you get higher cash prices. So who wouldn't take 1060 May beans as a selling opportunity, and May corn, selling May corn up around $4? I know a lot of people would take that. That's almost a 30-cent rally from where we're trading at here in the overnight. Another strategy, we're going to talk about this here in a second, selling carry in the market, corn, soybeans, and wheat. And generally, you do that in big supply years. You sell the carry because that carry rarely gets met. What that carry means is all these contracts, July corn trading at 380 is carrying a premium over the December contract by about 27 cents. The market's giving you, as a producer, an incentive to sell that carry, and you can sell at a price much higher than what's offered today. And we're going to see if that makes some sense to do that here in, as I said, just in a second. In big crop years, normally that carry does not get met because we have so much crop. There's no reason that we have to continue to keep that premium in there. We usually lose that carry as we move forward. Okay, let me switch screens here, and we're going to go to my other screen monitor. All right, you should be able to see a screen now of our homepage here, and I'm going to show you how to get to storage calculators that we have on our website. And you go to our website here, and you go to this premium content login. It'll take you to our VIP access. You click on to log in on that, and you have access there to our daily commentary, speculator section, our hedge program section, our market insider weekly section, and you click on the hedge program, and right there is your storage calculator. So if you click that, it will take you to corn, soybeans, or wheat calculator. And I'm going to pull up the corn calculator first here, and center that a little bit. What I've done, it pulls up a screen like this automatically. In these gray areas that you see, you can highlight what current price levels are at. Interest rates at 5%. If that goes up or down, you can change that. I've already entered these prices for the December corn price, March, May, July. The carry that's being built in there is about 27 cents, as I said, from December to July. And this calculates how much it costs per month for interest, not for storage, just for interest, because there's a cost of holding that if you have loans that you need to pay down, or if you have just want to use the cash for something else. You can change this interest rate to reflect whatever you have, and that will be reflected here in this carry minus interest. And then it gets into storage costs. If you have your own on-farm storage, you don't have any storage cost. July corn, your net price right now is $3.70 versus $3.52 that you can get out of the field. So you get paid extra 18 cents by storing that at home. The difference comes in if you pay an elevator to do it. A lot of elevators are going to charge at least 3 cents a month. Calculates it's 18 cents to carry it to July if you're paying elevator storage. So right now the price is at $3.52 for current prices, but if you factor in storage and interest charges, you actually break even by going to July, and would make a little bit more money if March or May. So it makes a big difference whether if you decide to store this crop, if you have on-farm storage or not. We're looking at soybean prices. I did the same thing. I entered in here cash prices, the interest rate Excuse me. And as we look at the prices in here, again, spot price today is about 951. This is a futures price, not a cash price, so you may see some basis improvement. And without any storage charges, you're going to get about the same price going out to July as what you would here at harvest, but you'd have all kinds of risk that prices would move lower. Of course, prices could move higher. And if you have storage charges of that same 3 cents a month, you're putting yourself behind the 8 ball here at trying to sell it into the July market. There's just not enough carry there to justify storing soybeans, especially as they are going to have a little bit higher interest rate charge, almost 4 cents a month, because they're a more valuable commodity. So you're much better off using the futures or options market. If you go ahead and merchandise some product now or even into January, March, you're much better off re-owning that with a lower risk call option. And any of our offices I know would be glad to talk with you about doing some of that. Let's look at the wheat market here. As I put this in here for spring wheat, this is Minneapolis milling wheat prices. Again, there's a good carry all the way through March and May, but after that it doesn't make sense to store it any longer than that. What strategy I think we need to look at is going ahead and making sales at this price level, stopping storage charges. So you didn't have any storage, you would actually end up with a decent price, better than what it is today. 643 in the March is the ideal price level, or the best price when you factor in your storage or your interest charges. After that, now you're looking at 643, and then you can either re-own it or else use futures or options as a strategy there for your marketing. All right, I think we're going to end this discussion here early, and if anybody has any questions, please contact us. This has been Brian Hoops for Midwest Markets. Thank you for joining us tonight. We appreciate taking your time to talk about this. We do think there's some marketing strategies down the road here that will be better opportunities than what today is. If you have any questions, contact our offices. They'd be glad to assist you. And have a good night, everybody. Talk to you soon.